Right now, while you're watching this video, 3 of the largest central banks on Earth are in the middle of doing something they have never in modern history done all at the same time. Not next quarter, not sometime this decade, right now, this week, possibly today. And before you assume this is another one of those, the dollar is collapsing tomorrow, videos, it's not. And honestly, those videos do you a disservice because they make you tune out the real thing that's happening underneath all the noise. I'm talking about 3 specific, traceable, documented moves happening in parallel, each one quietly redefining what money even is. I'm not naming them yet, not because I'm trying to be dramatic, but because if I just throws the answer at you cold, your brain will file it under clickbait and move on. You need the size of the problem first. So here's the only thing I'll say up front. This isn't a story about the economy in some faraway, doesn't touch me sense. This is a story about the number sitting in your bank account right now and what that same number will actually be worth to you in 2 years. This is personal, and it already started without asking your permission. All right, quick pause, because I want to earn your attention here rather than just assume it. I've spent basically my entire adult life inside markets, the kind of person who reads Federal Reserve meeting minutes the way other people read box scores, who's tracked bond auctions and reserve currency data for longer than I'd like to admit is a normal hobby. I'm telling you this not to flex, but so that when I say something confidently in the next 15 minutes, you understand it's coming from someone who's actually sat with this data for years, not someone who read one scary headline this morning. Now, normally, the kind of breakdown I'm about to walk you through, the kind that connects Fed policy, gold flows, and digital currency pilots into one single picture, that's the stuff people pay real money for in private research subscriptions, in newsletters that cost more per year than most people's rent. I'm giving you the whole thing free right here. All I'll ask in exchange is 30 seconds of your time to hit subscribe fry before we keep going, because today I'm walking you through the first 2 of these 3 moves in full detail, and the third one, genuinely, the one that concerns me the most, the one where everything connects. That one is getting its own dedicated video right after this drops. You do not want to miss that context. Okay, let's actually build this out properly, starting with just how big this problem really is. Let's start with a number so large it's basically become meaningless through overuse, the US national debt. As of right now, it's sitting north of $36 trillion. And look, everyone's heard that number so many times it just bounces off now. 36 trillion, sure, whatever, next headline. So let's actually slow down and sit with it for a second, because most people have never once stopped to feel the size of that number. If you started counting out loud right now, one number every single second, no bathroom breaks, no sleeping, non-stop, day and night, do you know how long it would take you to count to 36 trillion? Over 1 million years, not 36 years, not 36,000 years, over 1 million years of uninterrupted counting. That's the number we're casually throwing around in the news like it's a grocery bill. But, and this is the part that almost nobody explains correctly, even in mainstream financial media, the debt itself isn't actually the disease. Countries have carried enormous debt loads before in history and lived to tell the tale. The debt is a symptom. The real problem is what a government is mathematically forced to do once debt reaches this scale, because at that point there are really only 3 doors available, and I want to walk through all 3 so you see why we always end up at the same one. Door number 1, raise taxes dramatically enough to pay the debt down for real. Historically, this basically never happens at the scale required, because it's political suicide. No government in a democracy survives the tax increases that would actually be needed to erase debt this large. Door number 2, default outright. Just say openly, we can't pay this. For a country whose currency underpins the entire global financial system, this isn't really a viable door either, because the shockwaves would be catastrophic, not just domestically, but for every country holding dollar reserves. Which leaves door number 3, and this is the door that every major empire in history, without exception, eventually walks through when debt gets this large. You inflate your way out. You don't default on the debt, you shrink its real value instead by making the currency itself worth progressively less. Quietly, gradually, in a way that never becomes a single dramatic headline, but shows up instead in your grocery bill, your rent renewal, your kid's college tuition. accumulation. That third door is exactly where we are right now. And inside that third door, there are three specific distinct happening simultaneously. Let's open the first one. The first move in this playbook is the oldest tool in the entire monetary history book, and it's the one already fully in motion: currency debasement through aggressive money creation. Here's where the say versus do gap becomes impossible to ignore once you actually look at it directly. Officially, the Federal Reserve's stated mandate is beautifully simple and reassuring: maintain price stability, target around 2% inflation, keep the system calm and predictable. That's the sentence you hear in every single press conference, delivered in that same boring everything is fine tone. Now look at what has actually happened to the money supply, not what's been said about it. Over the last 2 decades, and especially in the years since 2020, trillions of new dollars were created and pushed into the financial system in a matter of months. An expansion of the Fed's balance sheet at a pace with essentially no peacetime precedent in American history. The official statement says stability. The actual publicly available balance sheet data says expansion, and not a modest one. One of the fastest expansions of a major currency supply the modern world has ever recorded. That's not a conspiracy theory, by the way. That's a chart you can pull up yourself on the Fed's own website in about 10 seconds. The say and the do are simply two different stories. And here's what makes this move feel less like a scary new conspiracy and more like a well-worn historical pattern. This is almost exactly the tool used after World War II. Both the United States and the United Kingdom came out of the war carrying debt loads relative to the size of their economies that were comparable to, and in some cases larger than, what we're looking at today. And both countries used a version of the same trick, deliberately letting inflation run hotter than interest rates for a sustained stretch of years, which quietly shrinks the real burden of debt without ever requiring an official default. It worked. Debt-to-economy ratios came down over time, painfully but steadily, and nobody had to stand up and announce, "We defaulted." The public barely noticed the mechanism at all. They just noticed prices climbing steadily for a decade. That's the playbook running again right now, except this time the scale is bigger, the speed is faster, and it's happening to the world's primary reserve currency simultaneously, not to a single recovering post-war economy. That's move number one. It's already measurable, it's already public, sitting in official data for anyone willing to look, and it's the floor that the next two moves are built directly on top of. Now here's move number two, and I really want you locked in for this one, because this is the one that's newer, sneakier, and once you actually see the shape of it, it should make you genuinely uneasy. This one isn't about the US printing more of its own currency. This one is about the rest of the world quietly deciding it doesn't need to hold as much of that currency in the first place. Here's the mechanism, laid out simply. For decades, the entire global financial system has effectively run on something known as the petrodollar arrangement. In short, the vast majority of the world's oil and major commodities have been priced and settled in US dollars. That single arrangement is a massive, often invisible reason the dollar has stayed globally dominant even as US debt has ballooned, because it means every country on the planet, regardless of its politics, needs to hold dollars just to buy the energy that keeps its economy running. Now watch who benefits from quietly dismantling that arrangement piece by piece. Countries like China, Russia, Saudi Arabia, and the broader BRICS coalition have spent the last several years actively building alternative payment and settlement systems, negotiating bilateral trade deals priced in their own currencies instead of dollars. And here's the part that matters most, and the part that gets almost no mainstream coverage. Central banks around the world have been buying gold at the fastest sustained pace in decades, while simultaneously trimming their dollar reserve holdings as they do it. Not because gold is exciting or trendy, because gold is the one major reserve asset that doesn't answer to any single country's monetary policy, doesn't get diluted by anyone's printing decisions, and can't be frozen by anyone else's sanctions. Read that again, because it's easy to skim past. Central banks, historically the single most conservative, slowest moving, risk-averse institutions on the entire planet, are actively, measurably diversifying away from the dollar right now at a pace not seen since the early 1970s, back when the last major overhaul of the global monetary system happened. This isn't speculation or a fringe theory. This is published, verifiable central bank reserve data, updated regularly, sitting in plain sight. So line these two moves up next to each other for a second. Move 1 is expanding the domestic supply of dollars. Move 2 is quietly shrinking global demand for holding those dollars. Supply going up, demand going down at the exact same time on purpose in slow motion. You don't need an economics degree to feel where two lines moving in opposite directions eventually end up. And this is exactly where the first two pieces connect, because move number 3 is the one that ties this entire picture together. And honestly, this one deserves its own full dedicated breakdown, which is coming in the next video. But let me give you the shape of it right now so you're not walking in blind. While the dollar supply keeps expanding and global appetite for holding dollars keeps quietly shrinking, the world's major central banks, including the Federal Reserve itself, are simultaneously building, testing, and piloting central bank digital currencies. And once again, notice the official language used to describe this. It's always the same soft, reassuring, forgettable policy speak: modernizing payment infrastructure, improving financial inclusion, increasing transaction efficiency. Nothing alarming in a single one of those phrases. Now translate that out of policy speak and into plain, blunt consequence, the same way we did with move number 1. What it actually describes is a form of money where every single transaction can be tracked, where spending can be programmed with rules and restrictions, and where, if the underlying architecture allows for it, which in several published pilot designs it explicitly does, access to your own money can be limited or redirected in real time by whoever controls the system. Same exact trick as move number 1, the say versus do gap, just wearing a shinier, more modern outfit this time. The say is efficiency. The do is a fundamentally different relationship between an individual and their own money. Now put all three moves side by side, because this is the moment it all clicks into one picture. There's a version of the next several years where you're positioned in assets that hold real, tangible value while currency purchasing power steadily erodes underneath everyone else. And there's a version where your entire net worth sits passively, entirely in a currency that is simultaneously being expanded, competed against globally, and technologically restructured all at once without you doing a single thing about it. Realistically, those are the two outcomes on the table. One side sees this shift early and adjusts calmly on their own timeline. The other side finds out later, all at once, when adjusting suddenly costs a lot more than it would have today. So naturally, the real question is, okay, given all of that, what does an actual investor, not a professional trader, just a regular person trying to protect what they've built, actually do with this information instead of just sitting here anxious about it? Let's get genuinely practical, because that's the whole point of this video. First principle, and this is important, you do not try to time a collapse. Reserve currency transitions throughout history have played out over years, sometimes multiple decades, not overnight. This is not a sell everything tomorrow moment, and anyone telling you that is selling fear, not insight. This is a positioning game. The goal isn't predicting some specific crash date on a calendar. It's simply making sure your entire financial foundation doesn't depend on one currency's purchasing power staying perfectly flat forever, because history says it won't. Second principle, history's consistent answer to sustained currency debasement has been hard assets and productive assets. Gold is the obvious one, and it's quietly outperformed a lot of safe cash equivalent positions over the last 2 full decades, even though it rarely makes headlines for doing so. Real assets like property are another, and ownership stakes in real, productive businesses, companies that can actually raise their own prices as their costs rise, tend to hold up far better than cash sitting in a savings account, earning an interest rate that doesn't even keep pace with inflation. And if you want a simple way to track this debasement pattern yourself in real time without waiting for a video like this one to explain it after the fact, there are really 3 things worth checking on a regular basis. Is the money supply growing meaningfully faster than the actual underlying economy is growing? Are central banks around the world net buyers or net sellers of gold this particular quarter? And is your own personal cost of living rising faster than your income is? If 2 or 3 of those are all pointing in the same direction at the same time, that's not a coincidence. That's the pattern pattern live, in motion, happening to you specifically. One more angle worth adding before we wrap this section up, because it's easy to overlook. This isn't purely a just go buy gold and hide story. Companies with genuine pricing power, strong free cash flow, and minimal dependence on cheap borrowed debt have historically made some of the most effective inflation hedges that exist, often quietly outperforming what people expect from them during exactly these kinds of stretches. It's not only about what asset you own, it's about what kind of asset can actually defend itself once the ground underneath it starts shifting. Look, I want to be really clear about something before we end this. I'm not here trying to convince you the sky is falling, and I'm genuinely not trying to scare you into doing anything rash. All I'd ask is that tonight you actually sit down and pull up your own numbers. Take 5 honest minutes, look at what you're currently holding, and ask yourself what percentage of everything you own depends entirely on the dollar staying exactly as strong tomorrow as it is today. That's the whole ask. Just look at your own numbers.